Essentially, the bond market's caught the flight to quality bid here. Ultimately, the rates market is trading off of the Ukrainian situation right now, and it's kind of ignoring the macroeconomic data because the macroeconomic data is a bit stale. But you mentioned soaring commodity prices, and this really is probably the Fed's main concern here, is how this inflation genie stays in the bottle, and it's already busted out. And so as you look forward here, the rates market is kind of disconnected from what you're seeing on the inflationary side. But what you also see within the Treasury market is the curve flattening. And now you're really getting to where the inflation component could actually lead to this kind of more stagflationary environment where it really starts to cut off growth, as we've seen a huge spike, not just in oil prices, but commodity prices across the board. This goes for copper hitting an all-time high today. I think wheat prices hit an all-time high. I know they've skyrocketed on this Ukrainian situation as well. So although we talk about the Fed and signaling 25 basis point hikes, the Fed is still, I think, undeterred at this point to continue to start this hiking cycle, because absent even the commodity side of the equation, which a lot of the metrics they look at ignore commodities, there actually still is a lot of inflation in the system.
Yeah, and Lindsay, I mean, on some levels, it's a tough time for the Fed to be initiating a tightening campaign with the markets under this stress right now, and commodity prices not helping them out. However, the jobs number today suggests that there's a little bit of an underpinning of momentum in terms of labor market and consumer finances, at least.
Yeah, no, I was just thinking that in my head, is that the jobs report, it was so robust. And I think that the consumer is the one thing that can help kind of offset that growth side of the stagflation equation. I think the interesting paradigm that's happening here is that higher levels of inflation could and perhaps are pushing people back into the job market more quickly than we would have otherwise had anticipated. Stimulus is gone, and these consumers, especially on the lower end of the curve, really need to get back to work to be able to continue spending, regardless of what wages do. Even if they're able to raise it 10%, you're likely to see spending from the consumer come down. So that lessens the demand, which hopefully will help reduce perhaps some of the commodity prices that we're seeing at such elevated levels here. Reduced consumer demand for those items, helping to offset and ease the inflation situation over time.
So quickly, Jeff, why did bonds rally today? If the jobs number was so strong and the determination was that the economy is in good shape as we go into this hiking cycle?
I think it's the news from last night, and attacking a nuclear facility last night did not really bode well for the rates market. And so this is, I think, an example of people wanting to be defensive over the weekend, not wanting to own risk as we're seeing the situation unfold. So the bond market completely ignored the jobs report this morning. It ignored the fact that the wages are relatively flat. And you can take that in a couple of ways. You could say it's the hours worked that peaked that kind of drove that down a little bit. It could be positions that did that as well. But ultimately, the Treasury market right now is not focused on the backward-looking economic data. It's looking at the current crisis that we're facing in the Ukrainian situation.